Welcome back to the deep dive. Okay, today we're putting on our metaphorical hard hats. We're really going deep into the financials, the reality of a specific value-add deal. This is Fairlawn Apartments, 7576 Old Peppers Ferry Loop in Fairlawn, Virginia.
Right, and like we always say, the absolute first step is you got to forget the asking price for a second. Here it's $875,000, but that number, it means nothing really until you understand the actual asset. It's just noise otherwise.
Okay, so let's paint that picture. What is this asset? We're talking 17 units, apartment complex, total space is about 8,050 square feet. And here's the kicker, the bit that makes you pause. It was built in 1940.
Yeah, that 1940 build date, it immediately presents a fork in the road. You know, it's either this huge looming maintenance disaster waiting to happen, or if the current rents reflect that age and the structure's solid, it's actually a fantastic setup for adding value.
So that's our mission today, right?
Yeah.
Figure out which path this property represents for you, the listener. We need to sift through it, all the low rents, the potentially high expenses, and see if these numbers actually make sense for, well, the right kind of investor.
Exactly. Let's start with the building itself. That age, 1940. Look, it's only a deal killer if maintenance has been completely ignored, leading to like major structural issues. Assuming it's been reasonably kept up, that older construction often means the rents are way below market. And that's precisely the gap a value-add investor wants to see.
And you can see who they're renting to just by looking at the unit mix. It's 17 units total, but 15 of them are these small one-bedrooms, like 450 square feet on average. Only two slightly larger two-bedrooms at 650. This isn't really a place for families.
Oh, absolutely not. This setup clearly targets singles, maybe couples. It's what we often call the workforce demographic. And in that Fairlawn-Radford area, that means your nurses, your teachers, university folks, people working in local manufacturing. You know, steady, essential jobs, reliable tenants.
Okay, but 450 square feet. I mean, that's pretty compact, isn't it? My first place was barely bigger. Does that size start to limit who wants to live there, even in a stable market? Less closet space. No real dining room.
That's a fair question from a tenant perspective, yeah. But flip it around, look at it as the investor. That small size, it's actually a huge plus. Smaller units mean lower utility bills, super important if the owner is paying them. It also means less stuff inside to break or maintain. And crucially, it keeps the rent affordable. It lets you stay competitive in that essential housing bracket, always.
Right, affordability.
Yeah.
Okay, let's talk money then, because this whole value-add thing lives or dies on that rent gap. What's the current situation?
Well, the current rents are definitely on the low side. Those 15 one-bedrooms, averaging just $578 a month. The two bedrooms do a bit better, $625. So if you add it all up, the current potential annual rent is $119,100.
Okay, 119K current. And they go, what's the target rent after we, work some magic?
So with some cosmetic upgrades, this is key. The market projections show those one-bedrooms could hit $695 a month, and the two bedrooms could reach $850 a month. Stabilized market rates.
Wow, okay, that's a significant jump. Let's break that down. For the listener, what's the actual dollar difference? On those 15 one-bedrooms, you're looking at an extra $107 per unit each month. That alone is, what, $21,060 a year?
Correct. And then the two bedrooms have an even bigger leap, $225 per unit per month. That adds another $5,400 annually. Put it together, and the total potential upside just in rent growth is $26,460 per year.
26 grand more per year. That's roughly a 22% increase in potential gross income. I mean, just thinking about that 26K, that single number could cover like over 30% of your down payment in the first year if you pull it off.
Right. Big if, though. You use the key word, assume. You absolutely cannot just hike rents by 22% on day one. Try that, and you'll just have empty units bleeding cash. Vacancy kills deals like this.
So the rollout has to be smart. How do you handle the existing tenants? You don't want everyone leaving at once.
Patience is key. It's a 12, maybe 24-month process. For existing tenants, you do small, modest increases when their lease renews. Maybe $25, $30, just keeping pace. The real way you get to that full $695 or $850 is through natural turnover. Someone moves out, then you go in, do the renovations, and list it at the full market rate.
Okay, this brings up something important. We looked at comps, right, like Redcoat Manor nearby. They're only getting around $571 for similar one-bedrooms as they are. So is our $695 target even realistic without spending serious money on upgrades?
No. Simple answer. No, it's not. And that's the critical point. That $695 figure, that's for a renovated, stabilized unit. To command that rent, you have to give the tenant something more. We're talking cosmetic value add here. Fresh paint, new flooring, maybe update the fixtures, refresh the kitchen cabinets. Not a full gut job, but noticeable improvements.
Okay, cosmetic. What kind of budget are we talking per unit for that kind of refresh,
Yeah.
realistically?
Our estimate is usually somewhere between $3,000 and $8,000 per door. Let's average it out at, say, $5,000 per unit. If you
Mm.
roll that out across all 17 units eventually, that's $85,000 in required capital improvements. You're not just buying the building, you're buying this business plan, and that 85K is basically the seed capital for it.
Hold on, though. $5,000 per unit for a 1940 building. Is that really enough to get you to $695 rent? What happens if you open a wall for new flooring and find, like, ancient plumbing or knob and tube wiring that needs immediate replacement? Doesn't that
Mhm.
$5K budget just vanish instantly?
It absolutely can, yeah. And
Yeah.
that's precisely why your due diligence period, your inspections have to be incredibly thorough, non-negotiable. Our $5,000 estimate assumes the core systems, plumbing, electrical, HVAC, roof, are functional and safe. We're making a bet, essentially. We're betting the current low rents are because of tired finishes, deferred cosmetic stuff, not because the whole building needs fundamental replacing. But yeah, it's a tight budget. Execution has to be efficient.
Point taken. Very important point. Okay, so let's bring that $875,000 asking price back into focus now, especially knowing we likely need another $85,000 minimum for those upgrades. So is 875K a good price or not?
Actually, in context, it's remarkably cheap, and that low price is what gives you the breathing room, the margin for error you need. At 875K, your cost per unit is only $51,471. That's way, way below the average for similar sales in the area, which we saw were closer to $152,000 a door. Even the cheapest comparable property we found sold for over $87,000 per unit.
51,000 a door. Okay, that's the number that jumps out. You're buying it at about $108, $109 per square foot. And replacement cost, building this new today would be what, 1.2, maybe $1.6 million? So that
Yeah.
huge gap between your purchase price and replacement cost, that's your buffer, right? Assuming inspections don't reveal some hidden catastrophe.
Exactly. That difference, that delta, is your protection. But let's look at how it performs now. The current net operating income, NOI, is reported at $56,534.
Okay, so 56K NOI on an 875K price, that gives you a current cap rate of 6.46%. And let's be honest, with interest rates where they are today, that 6.46% isn't exactly setting the world on fire, is it? Isn't that a bit of a turnoff unless you're purely focused on the future upside?
It is, yeah. 6.46% is just, okay, it's fine. You definitely aren't buying this place to just sit back and collect checks based on today's numbers. You buy this property based on what it can be after you execute the plan, the future stabilized performance, and that looks much better. The pro forma, the year one stabilized projection, shows NOI hitting $72,572. That pushes the cap rate up to a much healthier 8.29%.
Okay, now digging into the operations a bit more. The current expenses are listed at $56,611. That gives you a 50% expense ratio against the current income. That seems high, even for an older property. Tells me there might be some fat to trim, some operational slack.
Oh, yeah. And if you look line by line through those expenses, one number practically screams at you. Water and sewer. It's $15,600 a year. The landlord is currently footing the bill for $918 per unit per year just for water.
Wow, that's a huge number for the owner to absorb.
It is. And this right here is probably value add liver number one on the operations side. Implement a RUBS program, Ratio Utility Billing System. It allows you legally to bill back a portion of those utility costs to the tenants based on usage or square footage or occupants. Even if you only manage to recover, say, half of that massive water bill through RUBS, that's $800 dropping straight to your bottom line, straight to the NOI.
Okay, let's connect that to cash flow, assuming typical financing. Let's say you put 25% down. That's $262,500. Your annual mortgage payment, debt service, would be around $46,457, give or take.
Right. So based on the current performance, that 56K NOI minus 46K debt service leaves you with only about $10,000 in cash flow. Divide that by your $262K down payment. Your current cash-on-cash return is a pretty weak 3.84%. You could beat that in a savings account right now. Definitely a red flag for someone looking for immediate returns.
But again, the story changes after stabilization. If you hit that projected $72,572 Dome Key NOI, subtract the same debt service, your cash flow jumps significantly. And the stabilized cash-on-cash return, that leads up to a very respectable 9.95%. almost 10%.
Exactly. And that stabilized number feels more secure when you look at the debt coverage. That 72K NOI covers the 46K debt service 1.56 times over. Lenders typically want to see at least 1.25x coverage, so 1.56x is strong. It signals that even with some fluctuations, you should comfortably make your mortgage payments once the plan is working. Okay, so let's tally the upfront cash needed. It's not just the $262,500 down payment. We need that CapEx budget. Let's say you budget $50,000 for year one to handle immediate turns, some deferred maintenance, get things rolling. Your total cash into the deal is closer to $312,500. We have to be real about the risks. What could absolutely crater this deal after you've put in over $300?
The biggest killer is always that major capital expense that maybe wasn't obvious during inspection. A surprise roof replacement. That could be $50,000, $80,000 easily. What if all 17 HVAC units are older than expected and start failing? Replacing all of them could run anywhere from $51,000 to $85,000.
And think about that relative to the purchase price, $51K per unit. If you suddenly need an $80,000 roof, that's like wiping out the entire value of more than 1.5 units just to fix a basic structural component. Even at this low entry price, that's a huge hit.
It is. You absolutely have to have reserves or factor that potential cost into your underwriting. Risk number 2 is execution. Pure and simple. If the investor's bad at managing the property, or if they push rents up way too fast without delivering the promised upgrades, or if the renovation work is shoddy, you could face a mass exodus of tenants. Occupancy plummets, income disappears, and suddenly that 1.56x debt coverage looks very shaky.
This really helps define who should be looking at this deal, who's the right fit.
This deal is tailor-made for a local or maybe regional investor, someone hands-on. They need proven experience with value-add projects, they need to be comfortable managing contractors and the renovation process, and their focus needs to be on long-term cash flow, not a quick flip. This is definitely not for a passive investor just looking to park money. It's not for someone brand new to this, and it's not for someone trying to get in and out in 18 months. The execution risk requires active, experienced management.
Okay, let's assume you are that right investor and you execute well. What's the long-term play look like? Say you hold it for 5, maybe 10 years. You stabilize the NOI, maybe even grow it a bit further through efficiencies. Let's say it hits $84,199, and then you sell it into a stable market, maybe at a 7.5% cap rate.
Run those numbers. $84,199 NOI divided by a 7.5% cap rate gives you an exit price around $1,122,653. Compare that to your $875K purchase price. You've potentially created almost $250,000 in value just through smart operations, raising rents, cutting costs like that water bill, managing well. The overall projected return, the IRR, internal rate of return, looking at cash flow and appreciation, likely falls in the pretty solid 15–17% annualized range in a reasonable scenario.
And we can't finish without mentioning the tax benefits, which really juice those returns, don't they? Depreciation is huge here. On an $875K property, a big chunk is building value you can depreciate. Maybe $700. That means annual depreciation could be around $25,454.
Right. And this is where real estate gets really powerful for wealth building. Think about it. If your stabilized cash flow after debt service is about $26,000 a year, but you get to deduct $25,454 on your taxes as a depreciation expense, you're receiving almost all that cash essentially tax-free or at least tax-deferred. That cash flow hits your bank account, but your taxable income from the property is minimal. That dramatically increases your actual after-tax return.
Okay, so wrapping this all up for you, the listener, we've laid out a plausible path to solid returns. But the decision really comes down to you answering 3 key questions. 1, do you realistically have access to the $300,000 plus in capital needed for the down payment and the initial renovations? 2, do you have the personality, the time, and the local capability to actually manage this hands-on renovation and tenant management process over the next 1 to 2 years? And 3, does this kind of 5 to 10-year strategy focused on steady cash flow and eventual appreciation fit your personal investment goals?
Yeah, the final verdict is, Fairlawn Apartments at $875,000. It's not a steal. It's not a screaming deal. But it looks like a fair deal with very real, achievable upside if the value-add plan is executed properly. That low purchase price provides a crucial margin of safety, especially given the age of the building.
And like we touched on, if you can negotiate that price down, maybe closer to $825,000, then it starts moving from fair towards pretty darn good.
Absolutely. But take a step back, too. Remember the fundamentals of what you're buying here. It's workforce housing. Stable demand. It's in a decent, diversified market. Like Radford, you've got the university, healthcare, some manufacturing. It's a solid, foundational kind of asset.
That's the long view. Building wealth in real estate like this, it takes time. It's usually a 5, 10, maybe even 15-year game. This isn't a get-rich-quick flip.
And maybe here's a final thought to chew on. That really low purchase price per unit, that 51K, it provides more than just upside potential. It provides resilience. Think about a worst-case scenario. What if the market softens, rents have to drop 10%, and vacancy spikes by 5%? Because your entry point, your basis, is so low, even in that stress scenario, this property likely still generates enough income to cover its debt. That downside protection, that buffer created by buying significantly below replacement cost, that might be the most valuable aspect of this deal in an uncertain world.
That resilience is key. Excellent point to end on. Thanks for diving deep with us again today. We'll catch you on the next one.